recognize the gentleman from North Carolina, Mr. McHenry, for 5 minutes.
Thank you, Mr. Chairman, and Chairman Bernanke, thank you for your service to your government. You've certainly done so at extraordinary times, and we certainly appreciate that.
Thank you.
Much less having to endure a number of these hearings. It's certainly a challenge. But I wanted to ask you today about the municipal bond market. It's been a concern of a number of us here on the Hill, and a number of policy proposals have been put forward trying to bring transparency to that marketplace in terms of state indebtedness and municipal indebtedness, especially with their pension programs. Now, I'm not asking you to comment about Wisconsin or any of that going on, but do you believe that the municipal bond market could pose a systemic risk to our nation's recovery?
It could, in principle. While I should just be clear, while I understand that municipalities are facing some very difficult budgetary situations, both in the short term because of the recession, but also in terms of long-term obligations for health and pensions. Recently, tax revenues have been coming up with some recovery in the economy. A lot of painful cuts have already been made in many states and municipalities. So I think that the states and localities are making progress, to addressing those issues. That being said, I would applaud any efforts, to improve transparency and clarity. It would help investors, certainly, and it would force the states and municipalities themselves to address these problems, more head-on, I think.
Okay. So transparency would be helpful. Is this, in terms of the municipal bond market, is this something the Fed actively sees reviews what's happening and the impact it could have on treasuries and our lending at the federal level?
We review essentially every major financial market, and this is one of them, and we do have people who are paying close attention to developments there. I think recently things have improved a bit, is my sense. The tone has improved a bit lately, in part because of the better economy and because of progress that's being made on the budget.
Okay, certainly. And I want to shift a little bit, and this is something that at our last hearing on the implementation of derivatives regulations. And I know Ms. Maloney touched on this, but international harmonization. When we look at the derivatives piece and implementation of derivatives legislation, the regulators implementing the derivatives piece of the Dodd-Frank bill, we see that other major markets around the world aren't coming along as fast as we are. You could see Europe is maybe a year behind us. Is that a concern? Is that something that you're trying to bring other central banks around to this?
Well, I think in many of these cases, the CFTC, the Commodity Futures Trading Commission, is taking the lead in terms of trying to harmonize transparency rules, record-keeping rules, operational rules for clearinghouses and exchanges and the like. There are some differences which I don't think will be reconciled. Europe is not, for example, following the Lincoln Amendment approach, the push out of derivatives. So that will create some differences in the competitive position of American and other banks, I think. But it's difficult to assess at this point how significant that will be.
Okay. But in terms of ensuring that there is some harmonization with where our market regulation is moving, are these conversations you actively have with other central banks?
Yes, we are. We are having those, and there are international committees, for example,
the Basel,
like the Basel committees, which look at these issues and try to establish global standards. And we are all, as we set prudential rules, for example, for financial market utilities, we take into account these global standards. And so there's an attempt there to try to create a harmonization.
Thank you.
Yeah.
And I yield back.